Let me welcome ladies and gentlemen to this presentation. I'm going to give an investment update, how the fund's positioned and outlook for the rest of the year. So moving on, just a quick business update, but I think before I start, let me reiterate Centaur's three founding principles: to deliver investment excellence with outstanding service and utmost integrity. And these principles are really baked into the DNA of Centaur. All our staff live them every day, and I think if we can deliver these principles, I think we'll have some very satisfied customers. Centaur's a retail-only asset manager. We don't have institutional funds, and we achieved 40% assets under management growth last year to 6.5 billion. Also, Centaur's no spring chicken anymore, turned 21 in October last year, and I'm glad that we've got a very robust business with an exceptional track record, which I'll show in the next slide. There have been certain staff changes, some promotions and also recruitments to improve the depth within the business. First of all, Kirsten Dale was appointed as a key individual. That gives redundancy, that there are a number of key individuals in the business. Nick DeVos and Jacques Haasbroek are being groomed as portfolio managers to take over portions of the portfolio and provide succession over time. Len Walker, who was previously an analyst at Centaur, he emigrated in August 2020. He briefly left the employer of Centaur when he emigrated. He's now back on board as a full-time global analyst based in Edinburgh. We think this is a particularly good development. He's a skilled analyst, which is particularly good at finding new opportunities and working overseas. He's very close to the action, in touch with a lot of global businesses, and he is uncovering some great opportunities. So that is a fantastic development. We also recruited a new analyst, PJ Prinsloo. He's got 6 years experience with Ned Group. Just to give you some color on how the team is configured and faces to the names, we have a well-balanced team who's very stable. A lot of the team has been with Centaur 5 years or more, which really gives stability. Kirsten Dale heads up operations, and under her she's got 3 staff members who really deliver outstanding client service. On the investment team, 4 analysts and portfolio managers, and really a diverse skills base, and really know their tasks, and we split the market up into different segments which the analysts cover. We also have Mick, who's been with Centaur over 10 years. He's both a skilled trader and a very good quant analyst and a key asset to the team. I think one of our key pillars, key principles of Centaur is performance, and really this is very critical to us, that we outperform our benchmarks and deliver incremental value to our clients. Since inception, our performance is around 20% per annum, and our first clients are up 45 times. Our benchmark done 12% returns. We've handily outperformed our benchmark since inception. To really kind of explain our investment philosophy, there are really 2 key pillars. One, we call it dynamic value creation. So we see a company needs to create value for its shareholders at its cost of capital. Let's say that is 14%, and it releases value either by growing the pie or by throwing off dividends, but it needs to be growing at 14% to validate it as an investment. We also look for value arbitrage. We're looking to find a share that's also undervalued and growing. And there's an example below. You can see if we buy a share at 75% of value, it re-rates to fair value over 3 years, whilst growing, that return of 14% is leveraged up to 25%. And this is conceptually what Centaur is looking for, these kind of opportunities. We've distilled this process into repeatable themes. We've identified 25 repeatable themes, which are are breeding grounds for opportunities, and really driven by either management driving value creation or the market driving value creation. Then further, this kind of philosophy has been distilled into systematic models which aid the analysis when making decisions. This approach is evolutionary. It's not set. It changes over time. What we found, what worked 20 years ago doesn't work today, and one needs to evolve one's process to take into account real world changes. Looking at the flexible fund, it's been operating for over 17 years now. And the performance since inception, this is after all fees, almost 17%, materially outperforming its benchmark. And our first clients, possibly some of you on the call today, are up almost 14 times. Also, what's very gratifying is the one-year return of 28%, substantially outperforming the benchmark, but consistent performance over 3, 5, and 10 years, and #1 in its category over those periods. So we're very pleased to report a strong performance from the flexible fund. Just distilling where these returns came from. So we're looking at the major asset classes here. Fixed income, we were underweight relative to benchmark, so we had 17% in fixed income. Nonetheless, our fixed income component delivered a return of 9.7%. The reason why it's substantially more than cash is we had some preference shares which yielded over 30%. We had some government bonds which returned close to 8%. So that component added about 1% added value. That's the column on the right. Local equities, we were marginally underweight, so we had a weight of 54% versus a benchmark of 60. Nonetheless, we handily outperformed the benchmark with an equity return of 36% versus the benchmark of 27%. And the net effect is the value added from that component was 2.5%. Offshore equities were overweight, 29% average weighting over the year. And that segment delivered 35% returns versus benchmark of 32%. So value added of 4%. On the column on the right, we can tally it all up. And after fees and reconciliation, a net outperformance of 5% and an absolute return for the year of just over 28%. Just why would you be in a flexible fund as opposed to an all share or a tracker? I think what's important is the flexible fund provides a lot of downside protection, so it's not as volatile, but also if the market falls, the flexible fund won't fall as much as the market. And we've looked at examples where the market's fallen more than 10% since 2015. You can see in the table below, and the outperformance. So the green column on the very right, you can see when the market fell 11% in 2015, the flexible fund only dropped 5%. And also what we do, one of our strategies is often during major dips, such as the COVID crash in 2020, we find exceptional opportunities and we aggressively buy. And when the market recovers, our fund more than makes up and outperforms in the recovery phase. So just looking at the bottom, you can see the flexible fund has delivered over that period 11%, outperforming the all share index by 2.4%, but with substantially lower volatility. The balance fund has been running for over 8 years now and really starting to put together a very good track record. Since inception, 12% odd returns. This is a slightly lower risk fund than the flexible fund, consistently outperforming the benchmark. It's a very competitive category. Over 200 funds currently in this category, and over 3 years we're number 6 out of 175 funds, and 13 out of 143 over 5 years. Showing consistent good performance on the balance fund, and we're looking to continue this in the future. Moving on to the performance of world indices. The black line is the performance of the MSCI World Total Return Index. You can see for world indices, it's been an incredible place to be. That index has doubled over the last 5 years. The S&P 500 done slightly better, that's the blue line, and the NASDAQ has been an exceptional performer, up 3.5 times over the last 5 years. And let's start unpacking where some of this performance comes from. So just looking at interest rates, which really drive ratings of shares, it's an interesting picture. So starting off with the blue line, that's the 2-year average core CPI of USA. And you can see it's over 3% at the end of December, around 3.2%. The US bond rate, which is the gray line, was about 1.5% at the end of December. And if you subtract the gray line from the blue line, you get the red line, which is the real yields available. As you can see, since June 2019, there's been negative real yields in the US 10-year bond. At year end, it was a minus 1.8%. So very negative real yields on offer. And what's that doing? What that is doing is driving money into equities. If you want to make real returns, the only game in town is to buy shares. And I'll show you on the next page what has happened. So the dotted red line is the period when yields went negative. So that's around June 2019. You can see the cyclically adjusted PE ratio. So this is the PE ratio looking over 10 years. Average earnings has escalated dramatically. So it started off that period at about 29 PE. That's up to about 38 times. This is the highest PE on record. And we are seeing a change in the interest rate cycle. And I think one must be cautious on valuations of these indices. There is scope for to derate with high interest rates, and some caution is warranted. Decomposing the indices further, what Centaur does have, it does have some proprietary tools where we look at different factors within the markets to identify what's working and not working. So this is not a comprehensive list. I've simplified it just for illustration, but you can see the low PE strategy. So this is the 20% lowest PE stocks in the universe. That's the dark blue line, actually underperformed from Jan 2017 to Jan 21. So 4 years of underperformance for a value-based strategy. Since then, it has actually turned around. The low PE graph, the dark blue line, you can see it's starting to turn up. That means it's starting to outperform. But conversely, investing in the most expensive stocks was a winning strategy until Jan 21. So that's the light blue line going up, but it has reversed since Jan 21, and now the line's turning down. So what it's saying is high P is not working, low P is working, so value-based strategy should be more successful. Another factor we look at, which is very important, is economic profit. So these are high return on capital where a company, its return on capital exceeds its cost of capital. And you can see that's a constant source of outperformance, the red line. And what Centaur is doing to find opportunities internationally, we're looking to invest in companies which both satisfy a low P and also positive economic profit. We think those shares, notwithstanding a derating in global markets, can continue to perform well. And we are finding a number of these opportunities. Looking at South Africa, the Rand, what we found is the best way of kind of predicting the Rand is looking at purchasing power parity and trade around that. So the green line at the top is the value of the Rand at year end was 15.9. The blue line is the purchasing power fair value of the Rand versus the dollar. At year end, we had a purchasing power fair value of 13.1. And the Rand at year end was over 20% undervalued. And you can see by the gray line, that is a pretty good level. We don't see massive disruption in South Africa. And what we did is actually brought dollars back to South Africa and remitted back into Rands by using a futures overlay. So we've traded the Rand very successfully using this model, really a contra-cyclical model. and hopefully we'll do this again. I think other reasons to be positive on the rand, it is undervalued, as this graph highlights, but we've also got a record trade surplus and also positive interest rate differential. So I think there's good rationale that the rand came firm in 2022, and that's how we've positioned ourselves, and so far it's actually showing some strength. Looking at equity content, we don't necessarily predict equity returns, but what we do is we look for when conditions are favorable to be overweight equities. And what we have identified through an interest rate model during a tight interest rate period, which is really the red graphs on the left. This is when interest rates go up materially. That's the time to be underweight equities. And statistically, we've tested this. During the tight phase, equities returned a negative 1% compound return. During the loose phase, these are when equities outperform. This is when monetary policy is loose. That's when equities return 26% per annum. Currently, we're in the loose phase of the interest rate cycle, and we think conditions favor being overweight equities, and that's how we've positioned the portfolio. Just to give you an idea of how this works, so you can see in the period between 2015 and early 2020, we were underweight equities. This was during the tight phase of the interest rate cycle. That reversed materially in late 2020. We went overweight equities, and last year we had an 83% equity content. So we're looking to capture that equity outperformance, and we have successfully deployed this trading strategy. Also, you may see on the very right, we have tactically slightly reduced equity content. I'll explain that in a later slide, but strategically, we're going to look to be overweight equities. Just some news about South African economy. I think there has been a positive news. Gross national income was revised up by 11% based on 2020 numbers. You can see the effect on the right. So the economy is larger than was originally anticipated. And where this is positive is really South Africa's fiscal debt to GDP is materially lower. I'll show you a bit more in the next slide. We've also got a lower fiscal deficit to GDP and lower personal debt to income, dropping to 68% versus 76%. I think the net effect is South Africa is not as close to a debt trap as expected, and also positive for rating agents in time and scope for South Africa's bonds to re-rate. The first effect of this really came through in mid-December when Fitch revised SA's outlook to stable. Just looking what impact this has on fiscal debt to GDP, that's really the axis on the right. You can see in Feb, the 2021 budget review, the anticipated debt to GDP was around 80%. Now with the rebasing of the economy higher, the debt to GDP is closer to 70%. So this is a positive development. I think if nominal GDP can start outpacing debt growth, SA can avoid a debt trap. I think there is greater prospects for this happening. Looking at the yield curve, that's the gray line. So looking at different maturities, you can see the 5-year maturity, if you correspond that to the axis on the left, is yielding at 8%. 10-year bonds are about 10%, and 15-year bonds are about 10.5%. These are exceptionally good yields in global terms. If we deduct the historic inflation of 4.4%, that's 5-year historic inflation, we get a real yield based on that. And you can see the 10-year real yield is about 5%, and the 15-year real yield is about 6%. These are really mouth-watering real yields on a global basis. Remember, the US has negative real yield. So SA bonds do look good value, but I suppose one needs to be a little bit cautious on the fiscal outlook in South Africa. On the economic outlook, I think positive policy progress has been made over the last year. We've seen renewable energy tenders, some some positive progress on corruption, maybe not prosecutions, but I think they're definitely corruption is frowned upon, and since the end of the Zuma era, and also some tentative progress on infrastructure spend. I think there's stimulus in the form of South African low interest rates. So even though we've seen a 25 basis point hike, interest rates are very low by historic standards. We've got strong terms of trade with both coal, platinum group metals, and iron ore very strong. That's positive for us, and we're seeing a global boom. There's also better confidence among CEOs, and really because things are coming off a low base, there's a positive base effect, which creates confidence. I think if the COVID pandemic is over, this is a big if, because we keep having further waves, but there is a school of thought who thinks Omicron will be the last wave, and things like tourism, which is a very big employer and a broad employer across the economy, has been particularly hard hit. If this recovers, I think there can be increased consumer spending and really scope for positive surprises. I think load shedding and the crumbling infrastructures are retarding growth potential. There's a lack of state capacity and excessive red tape, further bottlenecks to growth, and really the economic foundation is not particularly strong, partially based on strong platinum group metals prices, which face electric vehicle substitution later in the latter half of this decade. But nonetheless, I think economic growth expectations are particularly low. So the SARB is only looking for growth of 1.8%. I think there's scope for material upward revisions, particularly if consumer spending starts picking up, and also because of the reversal of the KwaZulu-Natal riots, should be another base effect. So I think growth possibly closer to 2.5% plus is possible this year. Just how are we positioning the funds with this outlook? I think even though SA bonds look attractive relative to cash, I think there are real South African fiscal risks. And also if US rates move higher, that will retard the returns from SA bonds. But nonetheless, we are marginally overweight. I think cash is unattractive. It's yielding under 5%. Compared to the returns available in the asset classes, I think that's quite easy to be underweight. I think it's an opportune time. I think conditions are good for SA equities. Will remain overweight in equities, but we do substitute international stocks through direct offshore holdings instead of, let's say, South African stocks. But we're going to be overweight equities. I think we've given reasons why we're cautious on global valuations, but we do see opportunities in our stock picks that we have. For example, Dow and Entain, we think have very good prospects, not overvalued, and can deliver returns of 15% plus in hard currency, which we think is attractive. There's continual active management. We do switches to enhance the return of the portfolio. I think there's no dominant investment theme. I think the portfolio is really comprised of stocks which meet our selection criteria, and we are expecting a resilient or firmer rand. Just to show you asset allocation changes. First of all, you can see the equity content decreased 3% from 84 to 81%. This was really a tactical reduction rather than a strategic reduction. The biggest reason was there was a tender offer for Brightsphere that reduced equity content 2%. We also cleaned up some of the smaller holdings in the portfolio. Nonetheless, we are looking to increase equity content. Currently, the fund is at 83%, and we will look to move that towards 85% plus. So we want to remain overweight equities. We think conditions are favorable, and we need to be overweight. On the upper portion, if you look at fixed income, cash and equivalents increased 7%. A part of this was due to a future strategy. So you can see the 3% reduction in offshore cash. What we do is we did a 3% futures transaction. It's an overlay where we remit currency back to South Africa, and it's essentially converted into cash. So that's 3% of that increase. SA governments, we are tactically looking for the right time to increase it, and you can expect cash to reduce as we purchase equities. I think on the balance fund, a very similar story. You can see the reduction in equities for similar reasons and a slight increase in fixed income. I think we're also tactically looking to increase our bond exposure. I think really trying to get a better level before we increase it. Just some of our largest holdings. Entain, we've had this for a number of years. This is one of the leading sports betting companies in the world. What's particularly exciting is it's a technology company, particularly strong, gaining market share globally, and really the most exciting part of it is they're the second largest in the emerging US sports betting industry. They partnered with MGM. We purchased this very well. We still think it's undervalued with very strong growth prospects, particularly as US penetration increases. Exor we've had for a number of years. What we like about it, it's trading at over 40% discount to some of the parts, but really the leadership is exceptional under John Elkann. He's like the Warren Buffett of Europe, and we think at this level of discount, it's a good opportunity. They are going to undertake share buyback shortly. Dell is a new investment. It's led by super entrepreneur Michael Dell, who really took a dorm room business into a global market leader. We think one of the best businessmen of all time. Dell is gaining market share. So what they're doing is gaining market share, but also widening their product suite. And also they're gaining market share because a lot of their competitors don't have stock, whereas they have, and we see this continuing. We purchased on a very low P of under 8, and it's a particularly capital light business. We think this is really an exceptional value where it could actually be worth 2 times what we bought it for. Perhaps as another company we've increased exposure to. We see return on equity increasing, really driven by the operational improvements. They've invested in streamlining the operations and also reduced credit losses and gains of market share. We think it's been underappreciated, these fundamental changes in the business, and we purchased this below book value, looking for returns over 20% per annum in rands. I think really we've covered our strategy. Hopefully we've demonstrated that Centaur is really on top of its game. It's got a great team. It's got a philosophy. We're not resting on our laurels. And I think for you as clients, I think it's important we continually deliver superior performance, and that's really what we're striving to do. And hopefully in a year's time, I can present to you another year of strong returns. Thank you very much. That concludes my presentation, and now it's over to you on the floor for questions.
Thank you, Roger. Here's a couple of questions that were submitted earlier. Where do you see interest rates going in the next 1 to 2 years?
So South African interest rates on an upward cycle. So short-term interest rates, it's pretty certain they'll be up. We saw inflation has ticked up because of the higher oil price. So I'd expect continual interest rate hikes, but I'm not sure the quantum. I think it really depends on the inflation outlook and really oil price, which is beyond our control. But I'd imagine at least another 0.5% or 75 basis points further interest rate hikes in South Africa this year. I think we're also looking at interest rate hikes in the USA as well. Notwithstanding that, the bond rate could actually, the SA bonds could actually re-rate down. So you may be able to achieve very good returns on bonds if inflation expectations in South Africa drop.
Thanks. Is the local market still relatively cheap?
We think it's relatively cheap. So we don't see it as overvalued. I think the caveat is really economic growth. I think our view is economic growth should surprise on the upside. Hopefully we can get economic momentum going and the consumer spending and confidence. but we still think it's a good time to invest in SA equities. They should at least meet its cost of equity, which is probably 12-13% this year.
Great. Are you permitted to invest in ETFs and ETNs?
Yes, we are permitted. We have, for example, we have a platinum ETF, so we do have exposure directly to platinum. So we generally invest in ETFs or ETNs overseas where liquidity is greater than South Africa. So liquidity is a concern if we invest in those, and we'll only invest in the larger, more liquid ones.
Is PPC a newish position in the portfolios? And if so, what is the rationale for this given the rally over the past year?
So PPC is actually a very, it's an old position. What happened is there were concerns about its financial structure, that it would have to have a rights issue. We used that extreme share price weakness to dramatically increase exposure. That was about 15 months ago, but we also topped up last year. So we bought PPC exceptionally well, and you know, on some of the purchases we're up 10 times. But so it's not a recent purchase. We have trimmed it a little bit over the last quarter, but it remains still a large holding.
Thank you. That's all for questions.
So if that covers the questions, thank you very much. Thank you very much for your time. I think, you know, I've tried to put our position and really our value proposition succinctly. It's taken us just over half an hour. Thank you very much for your time, and hopefully we'll see you back in 6 months. Thank you.